How to use a stock market crash to reduce your taxes. Hey, my name is Sherman the CPA, and today I want to show you how to take advantage of a downturn in the market to reduce your taxes. I am going to walk you through a real world example of how I did this for myself, show you how a lot of people get this wrong, and then I will walk you through the concept of tax loss harvesting completely. I learned all about tax loss harvesting when I passed the Series 65 exam to become a registered investment advisor. And although I do not actively give investment advice right now, I promise you that the information that you are about to receive is top of the line. So watch this video until the very end for all the details. And please help this video reach more people like yourself by simply clicking the like button below. All right, so the strategy to reduce your taxes during a stock market crash is called tax loss harvesting. Tax loss harvesting is when you sell stocks at a loss and use the tax loss to offset the income you report on your tax return. And if you do tax loss harvesting correctly, you can do it in a way where you don't actually lose any money at all. If you sell losing stocks in your portfolio to create a tax loss and consequently invest the proceeds to invest in other stocks that rise in value as the market bounces back, then you won't actually lose any money. But let me walk you through an example of how I did this for myself, and then I will explain this concept even more. So in the fourth quarter of 2018, the stock market flipped and started dropping. At the time, I was invested in index funds that gave me exposure to the entire stock market. I was invested in US stocks, international stocks, large cap stocks, small cap stocks, you name it, I probably was invested in it. But regardless of my super diversified portfolio, everything in the market was down. So I decided to take that as an opportunity to tax loss harvest. In December of 2018, as the year was coming to a close, I decided to sell one of my index funds at a $10,000 loss. I had invested $50,000 into this particular fund and sold it for about $40,000. But then I took the $40,000 in proceeds and invested it in another diversified index fund that was down at the time. So as the market rebounded, so did my portfolio. So when it was all said and done, I effectively lost no money on paper, but I still created a tax loss for tax purposes. If I had simply held my index fund and did nothing, the same thing would have happened. It would have rebounded in value and everything would have been fine. But by selling my index fund while the market was down, I created a taxable event, which in this case was a $10,000 loss. And I used that taxable loss to offset some of my taxable income when I filed my tax return and ended up paying less taxes. So with that said, let's go ahead and talk about some of the common mistakes people make when trying to tax loss harvest in this manner. Mistake number one, selling to create a tax loss, but not using the proceeds to buy replacement stocks. If you sell your stocks at a loss and say you're doing tax loss harvesting, but you don't actually buy anything else, well, you are effectively losing money on your actual investment. Tax loss harvesting, when done correctly, should not result in a loss on your actual investment returns over the long term. If it did, then nothing here would make sense. You don't want to lose $1 trying to save 15 cents. No, what you're trying to do here is to take advantage of a temporary downturn in the market to recognize a tax loss. And the only way you can properly take advantage of this temporary downturn while recognizing the loss is to use the proceeds you receive from the transaction to buy other investments that will rise in the future. Mistake number two, falling victim to the IRS wash sale rules. The IRS can disallow your tax loss from selling stocks if they consider it to be a wash sale. Now, a wash sale happens when you sell an investment at a loss and repurchase the same investment within a 30-day period. For example, if I sold my S&P 500 index fund at a $10,000 loss while the market was down and bought it again the next day while the market was down, then the IRS would look at this and disallow the tax loss. So the key to doing tax loss harvesting successfully is making sure that you buy investments that differ from the investment that you sold. For example, you can sell one index fund and buy a different index fund with similar performance. And as long as the stocks in those funds are not identical, then you should be fine here. Mistake number 3, not using the tax loss to offset their taxable income. Tax loss harvesting is pointless if you fail to use your tax losses to offset your income when tax time rolls around. At the end of the tax year, your broker will issue you a 1099 form that you can use to report the tax loss when you file your tax return. Then you can use these tax losses to offset any of your capital gains during the tax year. But what if you don't have any capital gains, you might be thinking? Well, the IRS allows you to use a capital loss against up to $3,000 of your ordinary income every single year. And if that doesn't tickle you, don't worry. You can carry forward any capital loss that you do not use indefinitely. For example, when I recognize a $10,000 capital loss, I use $3,000 of it to offset my ordinary income in the current year. And then I carry forward the $7,000 loss, which I plan to use in future tax years. Now, if I sold stocks in the next year and have $7,000 in capital gains, then I could use all of that capital loss to offset it in that tax year, because there are no limits to using capital losses to offset your capital gains. But if I had $0 in capital gains, then I would only be able to use $3,000 of the tax loss against my ordinary income and continue rolling the excess amount forward every year. So those are the 3 big mistakes to avoid. Now, if you want to take advantage of the next opportunity to tax loss harvest, this is exactly what I would do. Number 1, build a diversified portfolio. The reason why I was able to tax loss harvest without actually losing money is because I invest in diversified index funds that track the stock market as a whole. And there are a lot of different funds that allow you to do that in different ways. So when the market is down, I am able to easily sell one of those funds and buy a different one with similar performance to the overall market. Now, this would be a little bit more complicated if I invested in individual stocks, because as you know, individual stock returns may not actually correlate with market performance. In fact, there is no guarantee that a losing stock would ever bounce back. So the very first thing I would do is start building a diversified portfolio. And not just for tax saving purposes, but also for wealth creation purposes. By the way, if you want me to create a video on how to invest in the stock market, drop a comment below, and if I get enough of them, I will go ahead and do it. All right, so number 2, consider selling when the market is down. The next time the market is down, consider your situation and determine if tax loss harvesting makes sense for you. You might consider any capital gains you may have in the current year, or maybe you just want to go ahead and create a tax loss that can be carried forward for multiple years down the road. Either way, make a decision that is best for you, whether it be to tax loss harvest, buy more of the same funds you already have, or to just do nothing, which is completely fine. Number 3, invest in other assets as soon as you receive the proceeds. Have a plan for the money you receive from selling so you can put that money to work immediately. I'm really big on taking advantage of the markets when they are down. So if you are investing in the total stock market, like I mentioned earlier, then you can bet that stocks will rise in value in the future as well. Number 4, use the tax losses to offset your taxable income. Don't forget to use all the tax losses to offset all of your capital gains and as much as your ordinary income, just like I mentioned earlier. And make sure you keep up with how much of those tax losses you are carrying forward in future years. These tax losses are your tax savings, and you don't want to miss out on any money you can save or get back the next time you file your tax return. All right, so that's it for today's episode. Go ahead and subscribe to our channel for more ways to save on taxes and increase your wealth. We have over 300 free videos now on YouTube from CPAs like myself, successful entrepreneurs, and investors. Thank you for watching, and I look forward to seeing you in the next episode.